Hey guys and girls, welcome to this week's episode of the B.Invested Birchy podcast. I'm your host, Nathan Birch. This is a show unraveling the truth to the facade of the 21st century. We're now X in the Matrix and waking up to motherfucking reality. I love these episodes that I have where I am answering questions in from you guys in the community. So if you have questions you want answered, drop a like, drop a comment on all social media platforms. My team will sift through them from time to time and we'll do videos answering these questions for you. So the first question today is a chart. It actually provided us with a chart, and it says, why only in 1950s did the house prices start to increase? So if those of you that are watching this on a device rather than just listening in a podcast, I will get the editor to throw up on the screen this chart. So if we look here from the chart, it says here in dollar terms, in the 1881 in Australia, the house price was $59,000. And around 1946, the price remained about the same. There's a few up spikes, and those up spikes were in and before the 1890s depression and the 1930s depression, and then there was some inflation spikes throughout those periods. However, it wasn't until about the 1950s that we saw house prices start to remove. And the reason being, I believe, is that we've had a divergence from monetary policy. We used to be backed by gold and silver with our currency. And I won't get into this fully today about what real money was and the money that we have today. But basically, they just print endless amounts of money. We're on a debt-based fiat currency system today. Fiat currency is just where they print it and they say the value's there and they buy bonds. And this has happened since around the 1970s. It really ramped up, but prior to the 1970s, between the 1930s and the 1970s, we started entering into this phase. So if you do look at any chart, and I encourage, if you're just listening to this on a podcast, to go and look up a chart for, house prices over the last 100 years in Australia and look at these charts, because it does leave a very telltale sign of how we ended up with properties at the prices where they are today. So, from 1970, it was 1966 we changed our currency from the pounds and the pence to the dollars and the cents. It was Valentine's Day, February 14th, 1966. So that's where things started to change around there, because our old currency was not possible to manipulate and for us to have the rapid expansion of growth like we have. So how they bring on growth is by manipulating the currency. And here we see from 1970s, every decade, and that's why those property clocks come out from about the 1950s and 60s, saying every 10 years there's a bull and bust cycle where the markets go down and then go back up, and there's all these growth parts. But in 1970, it's when the dollar finally departed and decoupled from any value of dollar, and we went from the Bretton Woods system to the petrodollar that we're on, which is the 15th of August 1971. And since then, it's just been completely fueled from cheap debt, cheap credit. And a couple of times along the way, we can see that if we look back in this chart, there was an 1890s depression and a 1930s depression, but there wasn't recessions every decade. But then we go onto the chart and look at the 1970s. We changed our money supply then. And then straight after, we nearly lost our dollar within the first decade because of inflation. Inflation just ravaged the system because of this. So they tried to stabilize it again. We had a 1980s recession. Then we had the 1990s recession. So every few years there's a recession, 1970, 1980, 1990. Then we had the GFC, but we also had the Y2K bust with the tech bubble. And then the GFC, and then the illness of 2020. And it's like every 10 years there appears to be a bull boom cycle. However, what they're doing is each time they're crashing the economy, they're printing more and more dollars. And it's not that the property is going up, it's that the dollar is losing its value. And until all of us really understand that, then there won't be a mass awakening. The day will come of reckoning, but it isn't yet. And the debt ultimately just becomes more and more worthless. So you can pay off today's debt with tomorrow's devalued currency. So that's my answer for that. That's why in the 1950s we saw the growth that we had. Yeah, there was migration. It's not just all the monetary side. There's different levers that the governments and the central banks around the world have, because they have the lever of printing cheap credit. Then they have my parents, they bought their house for very cheap. I think they paid about $13,000 about 60 years ago for the thing. And when they bought that house, my dad had to go to the bank. So he had one income family. Dad had to go to the bank and wear a suit and propose, hey, can I get a loan for 50% land, right? That's how things were back then. However, now the banks are trying to get you in for a $2 million loan. They've got the husband, the wife, the kids are basically working. There's 2 generations living in the house to try and support their household because they've just printed too much debt and enslaved everyone with debt. So that might be a bit of a long answer, maybe not the answer you're looking for, but that's the answer that I see. And I'm obsessed with this, right? I've been obsessing over this for the last 23 years as an investor, and about 37 years of, 27 years of wanting to buy a property, but not being able to buy a property for 27 years. But the 23 years that I've been investing, that's the only answer I can come up with. And it's a bloody perfect timeline when you overlay it with what's being presented to us. The next question I've got here is, how do you get 10 in 8 months? So what I think that might be referring to is, how do you buy 10 properties in 8 months? And there's probably a comment on a video of someone or a post of someone that's had their success story shared. Everybody's position is different. So when people come to us, sometimes people can't do much, right? I've had investors that have come to me and they can't do anything for 2 years, but they're spending that 2 years getting themselves in an order to be able to do stuff. And then they can go and run and do, 5 properties in a month and then get 10 in a year, that sort of thing. So if I was to break it down, I've got an investor this year that came to me. I'm recording this at the end of 2025. And this time at the start of the year, like the end of 2024, I spoke to someone and they had $120,000, right? And that was part equity and part savings. So it was like scrapped together. It wasn't like they had, hey, I had 120 grand in my pocket. And this person, I said, I want to see you at 30 properties in the next 5 years. And he goes, okay, Birchy, yeah, cool, I'll do that. And this guy is now at the end of the year, and he has 9 properties. I only spoke to him the other day. And I'll just use his scenario, and I might get him on for a podcast one day as well. But young guy, about 25, 26, something like that. And he came to us with his 120 grand. I bought him a unit in Melbourne for 305,000, and I bought him a unit in Darwin for 280,000. The week after settlement, this guy was able to go back to the bank. These properties were neutral to positive cash flow, so they don't impact his servicing all that much. And he was able to use that equity in the property, revalued to 305 to 480k. So there's 175k equity in just buying that property. So 175 grand equity there. 80% of 175 grand would be 140 odd grand, 130, 140 grand. And he revalued the one in Darwin from 280 to 380k within a month, within a week. He was pulling out 100 grand. 80% of that is 80 grand. 80 grand plus 130 grand, let's call it, is 210 grand. That set him with another 3 to 4 deposits to go buy the next tranche. So he came back, by the time he bought it, settled it, revalued, pulled out the equity, bought again. There's another 3 months had passed, and he's sitting at 5 properties. And then we're able to go back to those properties and pull out equity. One of the ones in Melbourne, he was able to pull out a bit more. And from the 3 that he bought, he was able to go and pull out equity and then buy another 3. So that's got him from no properties to 2 to 5 to 7. And then he's just bought another 2, which have just settled in the last week. So yeah, how do you get there in a year? It's getting the right assets, having the right strategy, and understanding what the bank needs. This guy has never seen any of the properties. If I asked him about him, he'd be like, fuck, I don't know. There was this mad one where I pulled out equity, whatever. He's buying based on what he needs, not what he wants. He didn't come to me saying, hey, I want a house I can subdivide, build a granny flat, whatever. He got what he needed and he's achieved the goal. So, yeah. The next question is, Nathan, if you have 10 properties, do you want them to be paid off or keep the balance of loans so you don't overpay tax? That's an interesting question. Whether you pay them off or not pay them off, that's a decision that you want to make. What I say to people is, if you want to get, say 200 grand income in 2026, let's call it, you're going to need 200 grand, 4 grand a week. If the average rent's $400, you're going to need 10 properties to get you there. That's paid outright, no debt. So first set's to buy 10, then to pay off the 10. How do you pay that off? You've got to work hard, pay taxes, all that. Better way is that you could just buy 15 or 20 and then they double or triple. Then you can sell off some of the property and pay out the debt, which is what a lot of investors do. But also, like myself, I got to the figure of 10 properties and I'm like, then I want 20, right? So you get to 20 properties and you're like, shit, I can sell them off, pay out my debt. And it makes you feel good because that's when the whole paradigm shifts, right? Because you have the ability just to retire at that point. But you're like, hang on a second, I want to push it a bit harder. But if those 10 properties that you bought for 200 grand are now worth 400 grand, that's cool. You've got millions and millions of dollars worth of equity there. But the rents, if they're neutral cash flow and they're renting for like $400 a week and your rent's gone to $500 a week, you've now got $100 positive cash flow times 20, which is $2,000 a week. You're halfway there without selling anything off. So you'd rather just keep the properties because it's only another 2, 3, 4, 5 years, pushing up those rents, refining things a little bit. And with those rents, then you can live off the cash flow. Or you can go back, pull out equity from those properties, and then go buy other assets like blocks of units, commercial properties, or whatever you feel obliged to do. So lots of options there. Everyone's goal is different. I don't get how you make money if you're pulling out equity. Well, I guess if you're just pulling out equity, you're just getting yourself in the debt. That's, not the game of it. But to pull out equity, if you have to save, let's say a couple of moments ago, I said about the guy with the property that he bought at the start of the year and got to 9 properties this year. If he had to save $100,000, that might take him 1, 2, 3, 4, 5 years to save 100 grand. If you can buy a property and then go and pull the equity out of it, you've got to go and pay, let's say, a 50 grand deposit for a property. 50 grand deposit at 6% interest is $3,000 per year, $3,000 a year in interest on that equity you pull out. 52 weeks is $60 a week. If you had to save $60 per week, it's going to take you 20 years to get there. If you can buy a property that you're pulling out 50 grand equity from, and then you've got, $60 a week cost for that, you can easily go and buy a new asset. If that's giving you $60 per week positive cash flow, then it's wiping its own nose on that front. So, you don't want to be pulling out equity to live off, but to expand your asset base, it can be a great tool for you to be able to do that. Next question is negative geared or negative cash flow. I don't like anything negative in my life, right? So if it's negative cash flow, negative geared, it's not that great. It's losing your money. I don't like owning a property that's costing you money. I want it to be positive. If you can make it neutral cash flow via a bit of depreciation and stuff like that, happy days as well. Next question is, I'm scared of the death tax / inheritance tax and property tax. They're always trying to tax us. Just understand that, the government's not your friend and you need to take control of your own life. There's ways around different things in different elements of life. I think it's important to have the right team around you and the right advisors. There is no inheritance tax today. They'll probably tax us a million other times by the time we all die. It's really shit. When you think about it, we live in the world, we own nothing. Even your house, you own nothing, right? It's all rented. The whole thing, it all goes back in the box. I'm not trying to sound miserable here, but ultimately, when you look at the taxes we have to pay, right? So if the house gets built, you have to pay all these state government taxes. Then the builders have to pay the GST. Then you have to pay the taxes on the builders that are working on the house to build the house. You have to pay all the taxes from all the things that you bought to buy the house, right? All the materials, right? And then you have to earn the income to pay the mortgage. You got to pay taxes on the income that you earned to pay the mortgage. And then there's taxes all along the way. And then you own the house. You go, finally own it. I'm going to sell it. We're going to come charge you tax. We're going to charge you capital gains tax, or whatever the case may be. And then you go, okay, well, I'm going to die. I'm going to pass it on to my kids. No, we're going to tax you on that. It's absolutely disgusting. I don't have an answer for you. But you can either sit there and participate or sit there and be fearful. And I think fear causes, inactivity and causes people to lose opportunity. So, I'd rather be taking action and then working out how to deal with the consequences of the positive outcomes that I've had than not taking action at all. But you're right, it does suck. And, I think it's going to be a lot worse in the lifetimes that we all live. Here's another question here, Nathan. So the key thing here is selling the original property, but don't pay off the loan completely by using the sales proceed to go back up to 299 of the 300 grand loan, then withdraw it as 20% LVR security for property number 2 and 3. Did I get that right? I don't know the concept of or the video that you've commented this on, but ideally, if you need money, right, for a deposit, this is just hypothetical. Let's say you need 100 grand for 2 deposits. You can save up 100 grand, or you can just go and ask the bank, hey, can I borrow 100 grand so I can go buy another property? That's where, that's where the fund comes in. So whether paying it off or not paying it off, there's lots of levers there, and all depending on personal positions, which I can't give you financial advice, and especially no one can give financial advice over a camera. But working out the strategy is very crucial. So if you do want a strategy worked out, reach out to the team. We'll put you in contact with the right people and work out what could be best outcome for you. Nathan, I'm tossing up between Bitcoin and property next downturn 2027-ish. Do you double in commercial at all for clients? There's a lot of questions there to unpack, right? I'm tossing up between Bitcoin and property. They're two different assets, two different ways of investing, two different risk levels. One brings in a cash flow, one doesn't. One's more speculative. One's had cool growth. The other one, they both had cool growth, but if we look at 2025, Bitcoin's down for the whole year. It's meant to be a boom cycle. Do you dabble in commercial properties for clients? I buy every type of property. I buy houses, shops, offices, industrial, blocks of units, villas. My favorite go-to are just standard, basic bread and butter residential properties because you've got the largest market share. Commercial properties, yes, I buy there, but commercial properties, to be very, very candid, as I always say, have intrinsically higher risks, much higher risks, and the returns are not better than a residential property. So I can challenge and debate anyone on that front. I own all the assets, so I'm not, I just think this is my best. I just know where the value in my growth in my journey has been, and it's been in residential properties. When I buy commercial properties, I've got a couple of dozen commercial properties. I've got motels. I've got like 25, 30 motels in the portfolio. They'd be considered as commercial. The risks that come with buying a shop, an office, or whatever, every time I've bought one of them, it's been with the most ridiculous terms. Like, just think about it, right? You drive down the road, no matter what area you live in, and you've all seen that shop that sat vacant for 6 months, 12 months, 24 months, 36 months, 48 months. All right. What would be going through that owner's mindset at that point? It's like, I'm dying, I'm going to drown, I'm going to lose my house. But there's no market out there to sell the thing because there's no tenant. The value of the asset is determined on what the income is coming from that asset. So, there's many, many factors, and you can't just rent out the property cheaper to get a tenant in there and get some rent. It's not based on an emotional purchase like a house or a unit would be. It's based on financial. So if you carve up the rental, you're carving up the value of the asset. So be very careful looking at that. Hey, bro, can we mention the new government's desire to tax unrealized gains on the podcast as implications and what we can do to minimize this impact as investors? We need your advice on this majorly. Well, thanks, bro. Firstly, unrealized capital gains tax is in the super fund. It's not in personal name capacity, and it's only for super funds with balances over $3 million. But sneaky little bastards will put things through like that, and then they will try and expand it into your personal wealth. I don't have the answer for it, and it hasn't happened yet. And I think the reason why it hasn't happened in the personal world is because there's lots of different special purpose vehicles, SPVs, like trusts and companies and different ways to put your assets into to minimize and dispose of that. And you got to think about it, right? Like, the people making the policies are backed by very wealthy people as well, right? Everyone thinks the government is God, but the government is just their middle management to the people to keep us away from the real wealth and powerful people. So the government's hands are slid by having think tanks and groups of peoples, whatever, behind them. If they changed it in a personal world, that would have massive ramifications on how every bit of tax is held, as well as supers and, imagine just drive to work or to home or go out for a drive on the weekend whenever you're listening to this, and think about all the buildings you drive past. Each one of them is going to be slugged like your house is worth a few hundred grand, a few $1,000,000, whatever. But there's buildings all along the road and the countryside. Just a service station, there's $5 million, right? $10 million shopping center, $50 million, $100 million, whatever. Those owners wouldn't allow that to pass, and they'd have to change the whole taxation policy from the end of corporate tax all the way down to personal tax. So there's a big hurdle for them to overcome. So I'm not too concerned about that, but they are fucking not there to help us. Can I make an SMSF and sell my investment property in personal name to it? That's a very good question. I don't have the answer for you, unfortunately. I believe it's very red tape because it's very compliant. If the property is no good under your personal name, why would you want to put under your super? You could possibly be doing better in your super. So just always think it's like an ex-girlfriend, If the ex-girlfriend was good enough to get rid of, you don't want to be taken aback, right? Why would you want to be getting a property if you don't see the value in your personal name? Why would you put under your super fund? So yeah, with it, get professional advice, speak to financial advisors, speak to an accountant. If you need help on getting access to one of them, reach out to the team. We can help you with that. Would you buy property today? You, not your company, you personally. When did you buy your last property? I own 12 properties, and like you, I did buy great. But today's market is designed to keep property stagnant, and this is understandable. We need the young people to afford a house. So time, stagnation. Would you buy now? As an investor, the math does not work anymore. Show me where it does. That's probably the best question I've read throughout all these questions and answers, right? Yes, I'm still buying. I've bought 30 properties personally this year. I'd say 25 of them would have been sub $200,000 properties around the countryside with positive cash flow rents on them. Just little shitty, cheap, affordable properties. There's still markets out there that allow that to happen. And then say 5, maybe 6 of them would have been $1 million to $5, $6 million properties each. So they're more on a commercial front or specific different types of assets, or blocks of units or whatnot. So I buy properties. I continue to buy properties. I've been buying properties for 23 years. I continue to buy properties, and I will continue to buy properties into the future. Strategy is important. If you're thinking of buying properties, I bought my first property in Mount Druitt back in 2003, right? And I think to myself, would I go to Mount Druitt and buy a property today for $1 million and rent for $600 a week or $500 a week rent? Absolutely, 100% no. It's the dumbest thing you could do as an investor. But at the time, it worked well. I have to go to different markets. I have to look at different locations. I have to look at different assets, and I need to make those numbers work for me to be able to achieve my goals. So just be open and fluid on that. The last question that I have here is, if you're buying property for cheaper than it was in 2005, isn't that a clear indication that it's a poor performing property? I would first question why it hasn't gone up in value in 20 years if I were to select that for me. Well, that is very good, right? Very good question. I'm a contrarian investor, and the best way for me to explain it is, and I've been doing this for 2 decades, this is my 3rd decade as an investor, and I buy stuff when all the people are scared, right? If I look at the Gold Coast, I was buying properties in the Gold Coast in 2015 that were cheaper than what they were in 2005. And the Gold Coast market peaked in 2010, 2008, 2010, and went backwards for a decade. And buying in 2015 for 150 grand, where some idiot paid 250 prior to that, I can get it. It sounds silly. Why would you buy it? It's gone undervalued. But I think, well, some idiot was prepared to pay 250 before. I'm getting it for 150. I just need to wait for that idiot to come back and pay a higher price, right? And property is not linear, right? It goes up and down. And I can show you in Sydney, I can show you in Melbourne. It's happening in Melbourne right now. I can show you in the Gold Coast, Brisbane, Perth, right? In all markets that go through cycles. So, and this is a big fear for a lot of people out there. And this is the biggest fear. The fear is actually the opposite of what you have, right? Because you see the fear based on, okay, it did nothing for a decade. but the fear is the risk of it falling backwards or doing nothing for another decade. So if I look at the Gold Coast now, those 150, 200 grand properties are 800, 900 grand. That's stupid. The numbers don't stack up, right? They're at the highest they've ever been. They've had never been there before. They've got price exploration. The cash flows don't work. And it wouldn't be too hard for that property that went from 150 it's easy for a 200 grand property to double to 400 and 400 to double to 800, but it's harder for an 800 grand property to double to $1.6 million. So what's the chance it's doubled? What's the chance of that 150, 200 grand property going to 900, now doubling to 1.8? The market doesn't allow that to happen. The chance of it coming from 900 back down to 800 would allow for a 100 grand correction and someone to be wiped out of all their equity from the property by doing that. So the risk is too far stacked on the worst scale. And the same thing can be said, everyone's buying in Townsville, right? It's stupid. I was buying in Townsville for 90 grand, 100 grand, 130 grand 3-4 years ago. Up until a year ago, I was paying 200 grand in Townsville. Everything's 400 grand, 500 grand, 600 grand, 700 grand in Townsville. Townsville, right? The chance of the average income being able to afford a $1.5 million property in Townsville isn't there. Your growth isn't going to be there. It could possibly, maybe, hopefully, potentially one day, but the growth is already done. It's toast. If I look at Perth, the Perth market went from 100 grand to 500 grand a decade ago, crashed for a decade. People were absolutely fucking decimated in Perth. And the market went back down to 150, 200 grand. So it's still up from where it was in the bottom before that. But, people lost out big time. And the growth was like, oh, yeah, growth, it's got up double, it's tripled, let's keep buying. But they didn't see that, the Grim Reaper was standing there at the end of the table. And that market crashed. And I was buying things when they'd crashed and they were cheaper than what some poor bastard paid a decade beforehand. And I was buying houses in Perth in 2022 for 200 grand. I was buying units in Perth CBD, right in the city, for 110, 120 grand. We bought hundreds of them, if not 1,500 of them. A lot of properties. And that market took off. And now it's 500 grand. And everyone's saying it's a great buy. I'm just like, you're fucking cooked. Because you're gonna get slaughtered, and people get slaughtered at the table. So yeah, that's my view on it. That's my personal view. That's what I do. And I'm not saying it being a smart ass, but yeah, like people are getting cooked out there, and it's suckers rallies. It's a thing. It's called a suckers rally, and you don't want to be a sucker as an investor. So I'm always buying under fear thoughts because of what is the worst case scenario. So I might be sounding flippant, like I bought this, bought that, bought the next thing, but I'm buying with all the risk factored into the deal. All the downside's removed and the upside is all there. So that's my view on how I see it as a contrarian investor. The term is a contrarian investor. I hope that answers the question. I appreciate you tuning in, listening, asking the questions through. I value the input from you guys. If you have any questions, please leave comments below. I'll come back and do some more of these videos in the new year. And thanks a lot for listening in this year. And we'll catch up soon. Have a great one. Don't forget, right? Every Thursday, Google Play, Apple Play, Spotify, and YouTube. Bye for now.
Like Bilal said, man, we stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated.